All right, everybody, welcome to this week's episode of the Raising Millionaires Podcast. I am your co-host, Roger Bryan, and that is
Richard Lorenzen.
And we are excited to have you here today. First things first, we are going to review some of the trade conversations that we had last week. Then we are going to talk a little bit about long-term debt. And We're talking about like U.S.-based national debt and whether it's good or bad, right? All debt is bad, so they say, but could debt be good? Stay tuned, and we're going to talk about how and when debt might be good. Richard and I may have opposing views, or we may just, no, I think we have opposing views, but we'll talk about that in a second. So first off, Richard.
Yep.
Last week.
Yes.
We talked about buying into the, what did they call that?
So just to set the context from where we left off last week, when we had met last on Tuesday of last week, the market was still kind of volatile and overall moving down after the really big leg down that it had the prior week on Thursday and Friday following the Trump tariff announcement. So after that announcement, the market had gone down 1,500, 2,000 points on the Dow per day, Thursday and Friday. And then we met the following week, Monday and Tuesday, the market was still moving lower. After that episode was when on, I guess was it Wednesday? I think it was Wednesday.
It would have been Wednesday, which would have been the day that the reciprocal tariffs were supposed to go in.
Right. And so that day on Wednesday, the administration announced a pause on those tariffs, and we saw a massive relief rally, or we can talk about in a minute whether we think it was a relief rally, in equity markets. And so when we met last week, you had talked about a trade that you were setting up in the options market. I believe that you were taking a bet on the administration coming out later that week and announcing a pause on the tariffs. So I guess you had bought some call options. How did it go?
Well, it actually went really well. I mean, there's so much in the news today about how much Trump is forecasting all of this, right? He's like, there's going to be pain, but if you buy now, you're going to make a ton of money, right? He's not even trying to hide the fact that you kind of need to follow along with it a little bit and take advantage of it. So while we were on the call last week, I had the SPY options up, and we were looking at the spreads. I was looking at it needed like a 2.5% move to the positive. We know that we typically see a 4 to 6% move on major news. So I was watching, right? And I was watching. I didn't execute while we were on the call. I went home, waited for Claire to get off the bus at 3:50, and then I ran in the house. I had 6 minutes left, maybe 5 minutes left. I logged in, and they kept going down. So what I was going to pay for, I think it was a 400 option call price, I was able to get for at a 395 with it going down. And I'm like, ooh, based on where everything's going to go, I just like gave myself a $5 cushion. So I bought. And then you and I are texting the next day, and I went home for lunch, and all of a sudden the market's like within it takes me 7 minutes to get from the office to home to go to lunch. So within 7 to 15 minutes, it went from like just down a little bit to spiking. And I was like, holy shit, don't know what's going on. I'm going to go in and sell. Closed out up 68% on a less than 24-hour trade. Who wouldn't take that?
68%.
68%. Well, hold on a second. Hold on. I want to be exact here. And I texted to you because then I also kept texting you about how I was driving myself insane for selling too early. Where was he? 495.
And so you had bought call options on SPY, right?
Yes.
Okay.
I
Index fund.
was up 59%. 59%. I bought them at 1478. I sold them at 2479. Less than 24 hours later, it was the SPY April 11th call at 495, price 1478, target 509.79, meaning I needed a 2.9% move, which is a little bit larger margin or a little bit larger spread than I wanted. I wanted 2.5, but I took it. But then I didn't look at why it popped, right? I just saw that it popped, exited, took the money. Man, who wouldn't kill for a 59% move? But then I can see I'm texting 59%. Damn, now it would be 100%. 2 minutes later, 150%. Then the news finally started coming across and I would have had a 200% profit. So it happened exactly like I said it would, right? But it was forecasted. I'm not the only person to see that. And you even talked about some traders that you know that have just turned massive amounts of money into massive amounts of money.
Yep.
The whole point of this was, if you're paying attention, right? There is not, take a step back. The 0-day options right now are on fire. That means buying options for the same day that they expire. People playing into the volatility, right? People are putting in, you could go in and put $1,000 into options and you've got a 4 to 10x chance, just as much as you've got to go down to 0 chance. So, right, if you can put $1,000 in and bet on a $4,000 to $10,000 return versus a $0 return, and you run that a couple days and you use proper probabilities, you should clean up. No administration in my lifetime, and I've been investing, you call me a day trader as far back as the 90s, when online brokerage houses first really became a thing, and I used to get in trouble in the Marines for trading on the computer because I didn't have internet access anyplace else other than when I was on base. I've never seen volatility like this, right? I know a guy that we both know, Tim Sykes, just sent out an email like this historic volatility. You've got to be playing this. And so the administration, crazy, lining this up perfectly, told us they were lining it up perfectly, executed exactly how he said. In hindsight, you always wish you could have taken more profit, right? For that to held too long, my timing, right? If you've got a Friday expiration and you're holding on Wednesday, it's going to lose 30 to 50% of its value if everything stays equal from a time value perspective. So you have to make a decision. But I should have looked as to why it was spiking. Within 15 minutes, it came across the wires that they had paused exactly like we said they would. And I could have tripled my money, or tripled what my profit, doubled my money. Actually, 200% is actually tripling.
Yeah, it's a triple.
Yeah.
Hey, the market is
looking for that same setup, right? It's not going to be extreme volatility, but I mean extreme negative, like bounce. It's the same way that I played NVIDIA earlier this year on the DeepSeek stuff. You knew it was a little bit overblown, right? There's not going to be some, what is it? Buy the rumor, sell the news. So that was kind of the rumor, right? And then the news came out that most of it was kind of artificial. Where do we look now for that is a good question. Pharmaceuticals and the auto industry. Certain things are starting to trickle through. Trump probably, like, I think there was already a thing today or news that came out that autos coming from Canada, they're not going to be, because our entire supply chain is Canada, Mexico, United States. We spent decades building that out. And I think if you ask anyone that knows anything about trade, they're going to say the U.S. has to level the playing field with Canada and Mexico. Right? You got to do it to keep the auto industry in business. So I don't know if you're going to see as big as spikes based on stuff, because I think a lot of it's getting cooked in. Pharmaceuticals is another place, right? Everywhere in the world sells their pharmaceuticals cheaper than we sell them in the United States. We import to keep costs down, right? So it's okay to think you're going to put up walls against that stuff, but might not work in the short term. The other one is airplane manufacturing. So much talk right now about Boeing and China stopping their orders as part of all of this. So there are other plays like this, but they're not as many macro market, like playing SPY for diversification and hoping for a whole market bounce. You got to start looking in the individual segments.
Well, that bounce that we saw on Wednesday when they announced the pause, also, that at closing on Wednesday, the Nasdaq was up, I think, 12%. So that kind of bounce is just something that I can't think of really any other headlines or news announcements that have driven like that kind of leg up. And you brought up a good point. I think it was last week you texted me and you had brought up the point of how maybe some of that relief rally was actually a short squeeze Because
Yep.
it's to see that
At least
much
half of it was.
volatility.
At least half of it was.
I think that's a fair argument, just because I can't think of any other period, any other news announcement that's driven like a 12% leg up on a
Yeah,
major index, and
this
so
is there's two parts to that. First off, remember on the call last week I said the QQQ might actually be better than SPY because it's got more oversold names in it.
it's got a higher beta
Started
overall.
2.9 to 2.5, and then I went in at 2.9 anyways, and I could have gotten an extra 30 or 40% bump on the QQQ. But this comes from crypto trading back in the day too. Anytime a crypto product, like say Bitcoin, moved 10% in one direction, it usually got another 10% bump because of a squeeze of one end or the other. Because
Hmm.
most of the platforms allow for 10x leverage. So you start seeing people having to buy out of their contracts at 10x or get liquidated. And then that would always accelerate the move in whatever direction. So there was always kind of this magic number. If you got around 9.5% move in one direction, if you bought into that momentum, you could usually see a doubling of that because once the squeeze started, nobody can stop it. And that's exactly what it was here. They were saying it was probably a 6 to 8% bounce, but the last 4 to 5% was all part of a short squeeze because so many people were short the overall market.
A week prior to that, we saw that fake news headline come
Yep.
out about announcing a pause, and you saw that immediate 8% move in the S&P, which basically telegraphed, I think we talked about it a few weeks ago on the show, it basically telegraphed what was going to happen if the administration did in fact come out with a pause. And sure enough, it did 2 weeks later. I don't think you'll see a lot of other moves like that, but it's also at the same time fair to say the volatility is going to continue. The VIX
Well,
it's
let's
at
talk about that
30.
for a second. What are some of the other things they can do? Because like we talked about individual
Well,
sectors or individual stocks, but like Trump's a wild card,
oh,
right?
also don't forget that this is a 90-day pause, and so in 90 days we're going to be doing this all over again. Probably not at the same scale, but if there's a mismatch in expectations on the market's part of what they think is going to happen in 90 days and what actually happens, you're going to see a leg up or a leg down. It's probably not going to be 12% in one day, but keep in mind this is a temporary pause, and it's 90 days to
It
do what,
is.
150 trade deals.
I know, but there is a part of me too that feels like, based on what we've seen recently, that the administration and the market understands that not putting deals together would be so catastrophic for the overall market that you can't really fuck around with it this time.
But does the administration view the stock market as a metric of success the second
Well,
time?
now here's the thing though, it's not just the stock market anymore. It's the bond market,
Right.
treasuries, it's the dollar, it's sentiment. Like it's now that the picture has been painted of all of these variables moving together. Trump might say that he doesn't care about the stock market, but he does care about consumer sentiment and how that affects spending and how spending is going to affect. Uh,
GDP.
there you go, GDP.
Right.
How GDP affects then the income for the government, how that affects their ability to pay the debt, which
Yep.
affects the debt ceiling, right? Somebody somewhere along the line gave Trump a fucking paint by numbers, and they're like, here, Donald, here's a crayon, connect the dots. And hopefully he got it. Who knows?
Well, you mentioned the debt markets. The 10-year yield has been coming back down after spiking over the past week.
There's
Um,
so much talk about you just don't see moves like this and that.
which is a big, obviously the 10-year yield spiking, that's a big problem. When the cost to finance debt goes up significantly, it's a big problem for companies. It's also a big problem for the U.S. government to finance their own debt. Um, so I think what you saw was some alarm bells going off in Washington, certainly here on Wall Street, around the 10-year yield and that spike that you saw over the past couple of days last week. So,
And they did make a good point on CNBC today. Right, you go back to 2020, and the yield was below, is it half a point? I can't get it exact. 0.65. Even though it's come back up, right? Historically speaking, if you go back more than 20 years, it's still a fraction of what it used to be. I don't know.
But this is after, the country had kind of become accustomed to cheap money for what, since 2008, basically.
Mhm.
So it's a painful withdrawal process for the economy to
Wasn't
get
that one of
off.
Santelli's things? Like, we've got to go through withdrawal on all of this cheap money, cheap product in order to. And this, okay, so this goes into the other topic
Right,
that
I was
we
going to say,
talked
so now
about.
we're starting the conversation about the debt and the deficit, right? Um, so obviously, historically, the United States national debt has been something that's been a concern. I feel like both parties kind of take turns being concerned about the debt, depending on who's in the White House. But the U.S. national debt, and then obviously fueling the debt, or driving the debt, is the economic deficit, the trade deficit that we have with certain or most countries. What are your views, Roger,
Oh, geez.
on realistically speaking, what is the imperative of actually paying down the U.S. debt, or at least closing the deficit?
So to have that conversation, you got to think a little bit about where the debt came from to begin with, right? And it's not just like, it is part of the federal budget, but that cheap money and that explosion in debt is the capital that has come into the economy through different engines or different levers and mechanisms to build out the robust economy we have today. So if you didn't have that debt, you probably would not have the economic engine that is the United States today. So
Yep.
there's a counterbalance to that, that if that cheap money is what's fueled the growth, can you continue to expand the debt in order to have more fuel to pour into the economy and allow for greater position of leadership on the world stage without getting into overarching geopolitics and how we made too many bad decisions about how that money was being used, right? China, what is it called? The Belt and
Belt and Road.
the Belt and Road, where they took the money, they invested in infrastructure, but took an ownership stake in all of it, and used it as debt that comes back. The United States kind of just started throwing money all over the world to do things.
Mm-hmm.
Didn't have a sovereign wealth fund, right? Didn't take direct ownership in any of it. Maybe through private interests they did. So basically, that funding of debt didn't build a core government-oriented engine to create future income, to create sustainability. Did that follow?
Yeah. No,
Yeah. Had they done the same thing that they did with the money, but they put it into a sovereign wealth fund and they allowed the money to come back in based on the external use of
Yep.
money, we might be having a totally different conversation. We might be better positioned from a sovereign wealth perspective, like a Saudi Arabia. I don't know what their sovereign wealth fund is, or is it Sweden that's got like $1 trillion in it? Some of these countries have put aside so much money, and don't quote me on those two. I should have looked this up, but we changed topics right before we started the call. But they've got enough money in there to like run their government for decades without any net new income, just living off the interest or earned interest on their investments. The United States, most powerful in the world, has no engine like that. So our debt has to keep growing and growing and growing to be sustainable. The mistake that people make is the perception that that debt just pays like government employees. It's so much bigger than that. That is a small
Yep.
part of it, but to
That's a
me,
very small part of it.
it's a very small part of it. And I don't want to give out numbers. I've heard them on TV and I don't remember, but it's like, it's very small.
Yeah.
Okay, I'm going to
Anyway,
stop
the
there.
primary
I'm
things.
going to Doge and everything. So
Ironically, one of the biggest line items in our budget, which is what's driving the deficit, is paying the debt, the interest on the debt, and then you also have defense, which is a big line item, and you also have entitlement programs like Social Security. I think those three things. I'm kind of going off the top of my head, but I think those three things are the biggest line items. And things like payroll for the government doesn't even come anywhere near some of those things.
and that's, I think often when you have a conversation about the expansion of the debt, it does come back down to the interest payment, right? Because when you borrow money and you pay interest, the time value of that money, like the value of the money is decreasing while you're paying it back, which makes it technically harder to pay back because the dollar is worth less. unless you're seeing an increase in the amount that you have coming in. So people always argue, you buy, and the interest rates today are going to make this totally different, but you buy a $500,000 house on a 30-year mortgage, you pay back at 5% like $780,000. The time value of that $280,000 relative to the underlying value of the asset, it does tend to appreciate and meet. But what if that money was spent doing something else? It's always a conversation. So if you look at how much we're paying in interest each year, and people ask the question, well, what if we had that money to be spending in our country instead? Then maybe we wouldn't need to expand the debt, but you have to shrink the debt to stop paying it.
Although maybe we wouldn't have that money if we hadn't spent the money that created the debt in the first place, which built the infrastructure that created the economic engine. I feel like there are two different conversations here. One of them is the kind of what caused the debt, right? Like the investments that we've made or money that we've spent to create the debt. But the other conversation is how the importance of paying down that debt moving forward.
I think the problem is, though, too, you just said how we used that money in the investments. That's the problem. We spent it, but we didn't invest it.
Right, but those are sunk costs at this point.
But they could have been sunk in a way to be investments.
They could have. They could have.
If my answer to the question was, if you map out, let's say, an 80-year plan for the country, and you reallocate that in a way that makes it investments instead of expenses,
right,
could you over time theoretically create a model that some point 30, 40, 50 years from now that the income and debt ratio crosses the other way and that we could have a net positive surplus? Theoretically, the answer is yes, but geopolitically, as soon as there's a surplus, they spend it, so you're screwed one way or the other.
Right. Well, I think right now Doge just figures that they can find enough things to cut out of the budget that, will just...
They just lowered their expectation from 1 trillion to 150 billion, right? So they're going to give us 15% of what they originally said they were going to.
The U.S. is a very expensive operation to run.
Say that? Say it again?
The U.S. is a very expensive operation.
Yeah, absolutely. With that being said, that 150 billion, right, is a big deal. Like, I'm not discounting it.
Yep. So now looking at the future, though, so we could structure things differently in a way that in the long term would create, but assuming that there isn't the political will to get that done in Washington.
Wait, what is political will? That doesn't exist in this country.
Right, exactly. And so just thinking about the currently, because the direction that policy is moving in, right? What we're dealing with is mostly spending less, earning more, earning less, spending more. Do you think that like a lot of economists do, and I'm not an economist, so probably a lot of our clients that are watching this who are economists are probably laughing at some of these points that I'm making. How do you look at the importance of getting a plan in place where we can pay down that debt over a long period of time through spending less, increasing revenue? Do we have to do it, in other words, or because of the reserve currency,
we absolutely have to.
We don't have?
I would probably fall into the camp more of a Ray Dalio. We're looking at economic cycles and looking at the stability of governments, the stability of world currencies, right? If you don't, the only direction that we can go, right? There's no way that this is sustainable forever. No operation, no business, no person, no one can run in a deficit forever. At some point, the underlying assets that they hold, i.e. the US dollar, becomes worthless because there isn't enough of it to pay for what's already been spent of it in the past, right? So then you get into your 80-year, 4-generation Ray Dalio's type cycle, and that we're at the end of a cycle, but in order to go into a new cycle, there has to be a complete turnover in government. And I'm not talking like a new president, I'm talking like a new country, right? Like a complete implosion of an economic engine not seen since the Great Depression or even worse, and that there has to be a rebirth. Rebirths can be good, right? They can be painful. There can be a lost decade for every human being, and the suicide rate could quadruple. But that's where we're heading, right? What the Trump administration is doing appears to be, in part, potentially, the right way to do it, build a sovereign wealth fund, invest in it, drive down the borrowing costs to lower the interest payments while driving up earned income from investments. And right, if you get that scale right, again, 40, 50 years from now, if you're borrowing money at 2% and you're earning a 7 to 11% return on it, over time, those numbers are going to cross paths. Whether or not it's sustainable, I don't know. But it can't go on forever. It has to be addressed in some regard. What are your thoughts?
No, I agree with that overall. I mean, like we were saying before we jumped on this call, I did hear a good argument recently from somebody who talked about, because of the U.S. dollar is the reserve currency of the world, right? So there's always an inflow of dollars that are coming into the system, and so that allows us to continuously finance basically an ever increasing deficit or debt, without impacting cost of borrowing or basically going insolvent. And I can see some of the merit to that argument in the short term, but in the long term, I lean more in the direction of the argument you were just making. Do you think that the U.S. currency is in danger in the next, let's say, 5 to 10 years of losing its reserve currency status? Because a lot of this would be kind of predicated on that.
In that short-term time frame, the only way that would happen would be a Ray Dalio-style catastrophic change between economic cycles, right? It's not going to happen passively. But then you have to ask yourself, okay, if it is going to happen, what's going to replace it, right? And I don't think it's going to be...
It's probably not China.
It's not going to be China.
Europe.
It's not going to be China. It's not going to be Russia, right?
Yeah.
Unless we go into World War III and they gang up on us and take out Western Europe, take out Taiwan, and then isolate us because we've isolated ourselves from the rest of the world, right? Then they would be competing for a world currency. But you notice how that's not a very passive thing, right? I'm talking about let's not go that far. World War III style economic change that we saw post World War II that made the U.S. the leader as it took over from the pound in the UK. There's another option though. Could somebody, a government, issue a digital currency that could become a world reserve currency, right? I think it's more likely to be a US dollar pegged one still, but we're talking major change. Do you think it could happen passively in the next 5 to 10 years? Like we wake up one day and we're like, oh, you know what? I need to be putting more rubles in my bank account.
No, that's the thing. I don't, so that's why when I think about like the national debt, the deficit, I don't see obviously I think there are outlier risks to the currency being the reserve currency, but I don't see it being a highly probable risk. And so to me, it seems like there's still plenty of runway to continue to finance a deficit. But is that, is it a 30-year sustainable plan? Is it a 100-year sustainable plan? Probably not. Also, it's worth mentioning the United States is a relatively young country, right? And so
I know people want to talk about how long China's been around, how long India's been around, and things like that. But if you look inside those borders, right, the China of today is not the same China of the 1940s, right? Just because we call it the same thing. And actually, the name has actually changed a few times too. Mm-hmm. Russia's a perfect example through the 80s, right? They may have been around longer, but that doesn't mean they haven't seen those economic cycles like Ray Dalio talks about, just internal to their own borders.
Mm-hmm. Also, I don't see any other currency that would be a candidate to become the new reserve.
Not without a major war, without a major conflict, right? I just don't see it happening. And that's one of the balancing acts too with trade and the debt is the value of the dollar, right? Is it a good idea to weaken it to give us strength in trade, or do you want to strengthen it to give us strength in rates, right? Because they go in opposite directions.
Yep. Right now we're seeing a dollar that's continuing to weaken more or less. I think that's I think there's a discussion going on between the administration and China right now over that
Yeah,
regarding
because they
the
were
tariffs.
talking about China devaluing the yuan.
Right.
What's 7? Peg, like I've always followed it at Peg 7. Where bonds, oil, gold, FX. What is it? US.
And the market is pretty much sitting at even. So some of the volatility has calmed down. People are waiting for something. There's no catalyst right now driving any.
No. And it might stay like this for like 90 days, uh, which like should be normal, but
There was an article this morning. I don't remember if it was which paper it was in, but there is still record inflow of money coming into equity markets, U.S. equity markets,
we talked about that
despite
on the last couple calls too, that there was something like $7.5 trillion sitting on the sidelines to play through this. I have most money managers that I've talked to or listened to online have gone from their average of like 10% cash allocation. Most of them are down to like 1 or 2%, right? That last dip was too good of an opportunity where multiples just dropped below running averages and that they had to buy, right? Whether it was algorithmically or it was like personal decision, you really had no choice but to put money into play when the numbers got to where they were.
Yep. Also, the volatility, it kind of reminds me of also like back in 2020 during the pandemic, where we saw those wild swings in the first few months of the pandemic that drove a lot of people into the market to try to.
Well, yeah, well, you had a combination too, right? You had Robinhood with his new types of
Right.
leverage for retail investors getting checks from the government, and then a market that's battered down. That's like a trifecta of opportunity to jump in.
Yep.
The problem is most of the people that jumped in on that then rode it up and rode it back down, or did
Yep.
got eaten alive by leverage.
One of our clients, it's an analyst, always says that volatility draws people to the market like moths to a flame.
Yep. And
And
most of them get burned and end up dead on the floor.
yep.
I don't think that's what they said, but I added my own little
Yep.
juice to that. So where do you go from here? Like, what do you do? I think we end all of our calls like, okay, we just talked about all of this craziness. Now, what is an investor supposed to do?
Well, I can say what I'm doing, which is staying long term. I still think that, there are buying opportunities when you see the market moving lower. Again, like not for everybody. I think you should consult your own advisor, but I still, I'm looking for buying opportunities when I see some of these dips. I think, staying long term it puts me in the best position to be able to ride out some of the volatility that we're seeing. We don't know what the next 90 days are going to look like when this tariff pause expires. And so I'm not trading as actively maybe as you are, but I'm still maintaining, overall a relatively bullish stance, granted that, I'm mostly committed to long-term positions and adding to those positions.
Yeah, and surprisingly, even though I talk a lot about trading, I have a cash allocation that I trade, and I have not touched or sold a single asset outside of the cash that was already sitting there since all of this started, right?
I I haven't sold a single stock since I think 2022, just to give you a sense of
Okay,
like
well, I can't say the same
I'm
thing
pretty
for you,
locked
but
in. So I'm pretty locked in. And the other thing is obviously, cap gains tax considerations and whatnot. But I'm pretty locked in, but I do actually maybe that's a good final question. So because we're talking about entry points and putting money in the market. Um, Personally, my system is I consistently invest a certain amount of money every single month, whether the market's up or down. There are certain names that I like to buy, and I'm just consistently doing that every month. And so the volatility hasn't changed that plan. It's still the same, but you as sometimes as a quasi trader slash investor might look at things differently. How do you look at I'm putting you on the spot because we didn't talk about this question beforehand, but how do you look at your buying strategy? Like, is it just a monthly automated thing, or are you making investments?
So, do I want to split this into three parts? The first one is that automated part of it has to be part of your plan, right? You max out whatever instrument you have inside of whatever company you're working for, whatever company you run, and you have to just max it out because it's found money, the tax advantages that come to it. I know when I did a consulting gig with a local service company and they would only do it through payroll, I'm like, just put as much money of it as you can into whatever investment tools that you have. I don't even care about the cash that I'm getting. And it added up so freaking fast with matches and things like that. I was like, this is crazy. The second part of this, my portfolio has always been built around, I earn the money, I put it into buckets. When I've got, say, $25,000 or $50,000, I'll use that to invest in a project, right? A lot of pre-IPO stuff. I kind of dipped into the startup scene, didn't have as much luck as I would have liked, but then I'm going to buy buckets, and those are usually 5 to 7 year investments. And then the third part of that is from an ongoing perspective is just opportunity seeking, right? I know in the fall of 2023, around September through Thanksgiving, when it was like a sure lock on the Bitcoin ETFs, it was easy to say that all of that money is going to double. So I've got all of my automated stuff going. I'm going to take my buckets and I'm going to take my excess and I'm going to put every single thing that I can into buying as much of the Bitcoin ETFs as on the day that they come out, and even buying up to the run-in with GBTC, which was an instrument before then. And I can remember buying GBTC at $5, and I think it's at 78 now, right? Just not touching it. Actually, it might be back. It kind of pegs dollar for dollar now. I don't even know what Bitcoin's at now, but 84. So it's probably $84 a share, and I think my average cost was $5.60 buying into that. So those are my three buckets and how I look at it. Now, as an entrepreneur, there are feast and famine years, right? So like in 2020 and 2021, no, 2020, I don't think I made any bucket investments. 2021, there was some opportunities and I did make a few. That's when I dipped into the startup phase. I think I've got 1 of 5 that's working out. And I'm hoping that 1 of 5 by 2026 pays for the other 4, because right now it wasn't the best idea. But as an entrepreneur, feast or famine. Some years I can make 4 of those investments. Sometimes I don't make one of those investments for 2 years.
That might be another good topic for an upcoming week, is talking about private investments, one of them being angel investments and kind of navigating that space and other assets. But that
market is so shady. Right? It's the only way that I can explain it now that I got into the biggest parts of it, sitting down with the people running billion-dollar funds in that space, learned the ins and outs of it, invested here and there, and watched just so much of it unraveled and how the investors are treated relative to the fund managers and how the cash flows work and things like that. Right? Their $2 million a year personal paychecks were never affected by the fact that all of these $50 to $150 or $250,000 investors lost everything, and then they just moved on to the next fund, right? The fund managers, and they don't even blink an eye, right? They take their fee, they go on to the next one. They take their fee, they go on to the next one. Just stay away from that.
You got to go direct.
Well,
you got to go direct.
You have to have an in often with that, right?
Right.
A lot of the direct investment opportunities that both of us have had is because we're providing services or things like that to the company.
Yep. All right. I guess we'll leave that there.
Yeah, I know. There's a whole lot to talk about there. Not that I have any opinions or factual data to back those opinions, but all right. Richard, thank you. This was a good one.
All right.
And we'll see you next week.